Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. In this deep dive, we're tackling something absolutely crucial. It's what really separates the traders who make it from those who just spin their wheels. We're talking about that gap between knowing what you should do and actually, doing it when the market's moving and the pressure's on. Our mission today, simple. We're focused on bridging that decision-making gap.
And let's start with a hard truth, something you really need to grapple with. Everyone thinks they know the right move until it's actually their money, their decision, their neck on the line. See, the real problem in trading isn't usually about not knowing enough. It's almost always about execution. Having a great strategy without the discipline to act on it, well, that's like having a loaded weapon with absolutely no trigger control. Dangerous.
That's blunt, but honestly so true. We see it constantly, don't we? The trader who can explain a perfect setup maybe even nails it in a simulator, but then live trading starts, real money involved, and it just falls apart. The knowledge is there, the action isn't.
Exactly. And that point of failure, that's what we clinically call the decision-making gap. Think of it as the psychological distance between understanding your edge and actually using it under stress. It pops up right where emotions, money, and that unavoidable market uncertainty all crash together. And what does it look like? Hesitation, impulsive trades you know are wrong, or sometimes just freezing, total paralysis. Most traders fail not because their system is inherently flawed, but because their emotional wiring hijacks their logical plan, the elite. They close that gap. They make disciplined action almost reflexive, automatic.
Okay, let's try and make that even clearer. I like thinking about it with a metaphor. Imagine this decision gap is like a bridge, right? Connecting your knowledge, your plan, to your actual trading actions. In theory, on paper, back testing. That bridge looks solid, rock solid. You built it with intellect. But in practice, when a market storm hits unexpected news, sudden volatility, that bridge suddenly feels incredibly shaky. Because most traders build it just with intellect charts, rules, data. They forget the vital part, reinforcing it with emotional steel, training for the pressure. So when the market storms inevitably hit, the intellectual bridge just collapses. And what happens then? You fall right back into fear, self-doubt, second-guessing, overthinking everything.
And that collapse, it isn't random. It's actually deeply rooted in how we're wired as humans. When you introduce real financial risk, your brain doesn't prioritize your sophisticated trading plan. Not initially. It defaults straight back to its primal survival systems. Fear. Greed, that urge for quick gain, and avoiding loss at all costs. This survival mode basically hijacks the rational planning part of your brain, takes it offline for a critical moment, and the result. All those classic emotional biases flood in. FOMO chasing trades you missed, crippling loss aversion holding losers way too long hoping they'll come back, turning small paper cuts into gaping wounds, or even that sudden dangerous burst of overconfidence right after a winning streak, thinking you suddenly can't lose.
Yeah, and we see exactly how costly these biases are in practice. Take loss aversion, like you mentioned. Intellectually, your plan says, cut the loss at point X, no questions, crystal clear. But the trade goes against you, hits that point, and you hold. You just watch it go further down. Why? That's the emotional brain screaming, don't take the loss, maybe it'll turn around. It overrides logic. And that manageable 1-hour risk you planned for, suddenly it's a 2-hour, 3-hour, maybe even bigger loss. All because the immediate pain of admitting you were wrong felt worse than the potential for a much bigger loss later.
Precisely. And then those failures create a vicious cycle, don't they? The financial hit feeds back into performance anxiety for the next trade. So maybe you've just taken a few losses, you're feeling bruised. Then a perfect A-plus setup appears. Your rules are screaming, go! But what do? You hesitate, you second guess, maybe you cut your position size way down, breaking your risk rules. Or worse, you just sit there, frozen, and miss the trade entirely. Why? Because those past losses made you overly risk-averse, completely outside your own plan's parameters. Or the flip side, analysis paralysis. Total inability to act.
The setup looks great, fits your primary rules, but maybe the VIX is a bit high, or some minor indicator isn't quite perfect. So you start digging deeper, looking for more confirmation, overanalyzing tiny conflicting signals, instead of just trusting your core strategy, the main signals you plan for. And while you're turning mentally, the opportunity just vanishes. That's the cost of what you might call high psychological latency. Delay costs money.
And the key thing to understand here is what we call the experience deficit. You can read every trading book, watch hours of videos, understand risk management concepts inside out, but none of that actually trains your emotional stability under fire. That knowledge is purely theoretical until you face real volatility with real capital on the line and successfully execute your plan despite the fear, despite the uncertainty. It's only through deliberate, structured exposure and practice, practice, practice that you build the psychological muscle to manage those impulses. True mastery isn't just knowing what to do. It's when making the right decision under pressure becomes almost automatic, deeply ingrained, not just a slow, reactive, logical calculation.
Okay, so we've really dug into the why, the psychological roots of why execution fails. But diagnosis isn't enough, is it? We need intervention, a practical way forward. If the problem is this execution gap, then we need a framework, a structured process to consciously, deliberately turn that knowledge into reliable action, a conditioned reflex. So let's get practical. Let's walk through the 5 critical steps to systematically bridge this gap.
Right. Step 1, foundational. Absolutely non-negotiable, and it needs to be clinically specific. Build a structured trading plan. And I don't just mean a general strategy idea. I mean clear, written down, rule-based criteria for entries, for profit targets, for your initial stop loss, and for how you'll manage the trade. Trailing stops, scaling out, whatever it is. Crucially, it needs rigid risk parameters, how much you risk per trade, max daily loss, etc. The plan has to be unambiguous. Leave zero room for emotional improvisation in the heat of the moment. And it should include your pre-market routine, too. Your checklist, your mental prep before you even look at a chart. Why? Because when fear or greed inevitably hits mid-trade, that written plan is your objective anchor. It's your algorithm to override the limbic system hijack.
Okay, solid plan first. Makes sense. What's step 2? Step 2 involves a fundamental shift in perspective. Develop a process-oriented mindset. Process over outcome, right?
Exactly. You have to shift your definition of success. Stop focusing solely on whether a single trade made money or lost money. Instead, measure your success based on how well you followed your plan, your execution quality, your compliance score. Did I enter where the plan said? Did I use the stop loss dictated by the plan? Did I manage the trade according to the rules? Did I respect my risk limits? If you measure and reward compliance with your process, win or lose, you start to decouple your self-worth and emotional state from the random short-term swings of the market. This is absolutely key for long-term psychological stability.
That decoupling sounds powerful.
Okay.
Step 3.
Step 3 is about skill transfer. It's practiced deliberately in simulated environments. And again, this isn't just casual paper trading, clicking buttons randomly. No. You need to use sophisticated simulators to actively build muscle memory for executing your specific strategy. Under various challenging market conditions, the kind of conditions that usually trip you up, you must deliberately practice the hard stuff. Managing a trade that goes against you fast, executing perfectly on a tricky reversal pattern, handling news events. And a critical part of this strategy is then gradually transitioning to live markets. Start with tiny, almost insignificant position sizes, microscaling we call it. This bridges that psychological chasm between zero risk in the simulator and actual capital risk, however small, in the live market. Build confidence step by step.
That makes a lot of sense. Focus, practice, then easing in. What's step 4? This sounds like where the real learning happens. It is. Step 4 is about rigorous self-correction. Journal your decisions. Systematically, not just P&L, right?
Absolutely not just P&L. That's almost the least important part for this purpose. Your journal needs to capture your emotional state before the trade, your specific reasoning at the moment you click the button, or didn't click it, and crucially, a detailed breakdown of exactly where and why you deviated from your plan if you did. The real gold here is in quantifying your execution failures. What was the trigger? Was it market volatility? Was it boredom? Did you hesitate for 5 seconds or 30? Did the deviation happen right at the entry or only after the trade went a little bit profitable and then pulled back? This kind of systematic documentation shines a bright light on those recurring, often subtle patterns in your execution errors that you'd otherwise remain completely blind to.
Okay, plan, process, mindset, practice, journaling. That covers the internal work. What's the final step? Step 5 addresses our inherent biases and blind spots. Use accountability.
Let's be honest, self-assessment is notoriously unreliable, especially when emotions and money are involved. We rationalize, we forget. So you need an objective outside perspective. Partner with a mentor, a coach, or even just a trusted trading peer. Someone who gets objective access to your metrics, ideally, your trade log, and that detailed execution journal we just talked about. And their job isn't to critique your strategy. It's to hold you relentlessly accountable to your plan and your execution compliance scores, not your P&L. That external, unbiased view is absolutely critical for catching those deeply ingrained habits, those blind spots, like maybe you consistently over-leverage only on Friday afternoons, and you don't even realize it.
That's a really solid comprehensive framework. Plan, process, practice, journal, accountability. That seems like the path to consistency. But what about going beyond just consistency? For traders who've maybe got that baseline but want to achieve real elite-level mastery, how do they keep refining?
Good question. That's when the focus shifts slightly, from just achieving compliance to really optimizing and conditioning the mind for peak performance. We move into more advanced psychological techniques, more proactive mental training. First, something mandatory for high performers: pre-trade mental rehearsal.
Like athletes visualizing the game.
Precisely. It's using neuro-linguistic programming principles. Before the market even opens, you vividly visualize yourself executing your plan perfectly. See the setup forming on the chart. Feel the potential pressure, the slight anxiety maybe, and then mentally rehearse flawlessly executing the trade according to your rules. Clicking the mouse, setting the stops, managing the position. You're literally building and strengthening the neural pathways for successful execution when the stakes are zero. This makes the real-time decision feel easier, faster, more automatic, and less emotionally charged when it actually happens.
So you're pre-programming the response.
Yeah,
Making it less of a conscious, effortful decision in the moment.
exactly.
Less friction. Next technique. Practice the advisor perspective exercise.
This is powerful when you're facing a really difficult, high-stakes, maybe anxiety-inducing decision during a trade. You have to consciously create psychological distance. Hit pause for a second and ask yourself, very deliberately, if I were coaching another trader, a friend, right now, in this exact same situation, looking at this chart, knowing their plan, what would I objectively recommend they do? By stepping outside your own immediate subjective emotional involvement, you force yourself back to a more objective, rational, plan-based decision.
That's clever. Detaching yourself. And what about managing the friction that comes with scaling up? Increasing risk often torpedoes performance, even for consistent traders.
Yes, a huge stumbling block. That requires what we call progressive desensitization to risk. This isn't just jumping to bigger sizes and hoping for the best. It's a controlled, systematic psychological protocol. You only increase your position size, your risk unit, after you have demonstrated consistent, measurable execution compliance following your plan at the lower risk level for a predefined period, say 20 trades or 2 weeks without major errors. You build confidence incrementally through a sequence of successful, manageable experiences at each risk level. And crucially, if your execution quality drops noticeably when you increase the risk, more hesitation, more rule breaking, you immediately drop back down to the previous comfortable risk level until your compliance is solid again. You essentially earn the right, psychologically and behaviorally, to trade bigger size.
Earning the right to scale. That ties right back into that process-oriented mindset, doesn't it? It's not just about P&L.
Yeah.
And finally,
Finally, it's about refining emotional pattern recognition, moving beyond just journaling deviations. This is about developing hyper-awareness of your specific internal emotional triggers, identifying the exact feelings, thoughts, or physiological sensations that reliably precede an execution error for you. Is it a feeling of boredom that leads you to take unplanned trades? Is it the euphoria after a big win that makes you suddenly feel invincible and over-leveraged? Is it anxiety about giving back profits that makes you cut winners too soon? By precisely defining the emotional fingerprint of your typical failures, you can learn to anticipate that internal state before it actually compromises your decision-making. This allows you to proactively deploy specific emotional regulation techniques. Could be deep breathing, taking a short break, repeating a mantra right when you feel that familiar trigger starting before it takes hold. Conscious intervention.
wow, okay, this deep dive really clarifies it. The path to consistent, profitable trading isn't really about finding some magic indicator or secret strategy, is it? It seems the entire battle is fought and won or lost right between your ears, inside your own mind. The execution gap is a psychological challenge demanding a structured, almost clinical solution.
It really is. The market will do what it does. Your edge comes from mastering yourself. So, the final thought, the challenge we want to leave you with is this. Take a hard, honest look. Do you really trade your plan day in, day out? Or do you just plan to trade your plan and then let emotions take over when it matters? Because until your actions truly, consistently align with your knowledge, you're fundamentally stuck in theory. You're an aspiring trader, not an executing one. Bridge that psychological gap. Do the work we've talked about, and you'll finally stop reacting like an amateur and start executing like a professional.
Trading an edge where psychology meets profitability.